Imagine for a second that you somehow got login access to the National Treasury's dashboard,
Oh, wow, okay.
right? You're looking at the federal budget's bottom line, and you see this upward revision, a massive, unexpected surplus projection of like $42 billion. dollars.
Which is just a staggering amount of money.
It is a staggering amount of money.
Yeah.
But then you look at the underlying reason for that massive financial bump, and the primary driver boils down to just one word: war.
Yeah, and it's an image that really grabs you by the collar.
Oh, absolutely.
Because seeing those two concepts, a massive national financial gain and a devastating overseas conflict, seeing those linked together feels incredibly sinister.
It really does.
Yeah.
I mean, human instinct just assumes someone somewhere is doing something highly unethical behind closed doors.
Right. It demands an immediate explanation. You just assume there's a shady transaction happening.
And if you've been scrolling through your news feeds lately, you've probably seen a version of that exact scenario playing out in the headlines.
They are everywhere right now.
Articles are practically screaming about how Australia has supposedly profited a staggering $42 billion from the recent Middle East conflict.
Which is just prime clickbait.
It really is. It's the kind of headline designed to make you immediately share it in group chats with like a dozen angry emojis.
Exactly.
But today, July 3rd, 2026, we are putting those claims under the microscope in this deep dive.
But we have a really solid stack of highly detailed source material to work through today.
We do. We're looking at today's newly published Resources and Energy Quarterly Report, the latest Reserve Bank of Australia interest rate data, and the official national debt figures.
Which honestly gives us everything we need to bypass that whole social media outrage cycle and just look at the actual mechanics of the global economy.
So that is the mission for this deep dive. We're going to separate the clickbait from the economic reality. We're going to track how global supply shocks actually ripple into a federal budget. And most importantly, we're going to decode what this massive, complex web of global commodities and domestic interest rates means for you, for your daily life and your wallet.
Because the underlying truth of how the economy actually functions here is way more fascinating and, well, definitely more complicated than a sensational headline.
Right. Okay, let's unpack this. Because when a headline uses the word profit in the context of a war, I mean, it makes it sound like a check was literally written to the Australian government.
Like a direct payout.
Yeah, like a direct payout for some kind of military or geopolitical involvement in Iran or the broader Middle East.
Well, to untangle this, we have to look directly at that $42 billion figure. The way it's being framed by some outlets right now is honestly a masterclass in causal implication.
Making you believe one thing directly caused another.
Exactly, making it look like a very neat transactional event. But there is no war profit. There is no check.
So where's the number coming from?
To understand that, we have to look at the timeline of Australian economic reporting. That $42 billion figure is actually a recurring number.
Wait, you really?
Yeah, it first popped up all the way back in the October 2022 federal budget.
Oh, wow. Okay, so this number has just been floating around government spreadsheets for years, long before the current specific crisis we're seeing in the headlines today.
Right. Back in 2022, the government forecast a $42 billion improvement to the federal budget's bottom line, and that improvement was driven by two very unsensational structural things.
Which were?
Soaring global commodity prices. So meaning higher baseline prices for exports like coal, iron ore, and gas, and a really strong domestic labor market.
More people working.
Exactly, more people were working, which meant more income tax was being collected.
Okay, but if it's an old number, I'm trying to figure out why it is suddenly headlining articles today in the middle of 2026 and explicitly linked to the Middle East.
Because the figure was just revived and recontextualized in the June 2026 Resources and Energy Quarterly Report, the REQ, which the Department of Industry, Science and Resources published today.
Okay, so it's fresh data.
It is, but here is the critical nuance being lost in the noise. The current $42 billion they are talking about today is simply an upward revision of a forecast.
Wait, so it's just a mathematical difference?
Exactly. It is the difference between what the department thought would happen back in December 2025 and what they now think will happen in June 2026.
I want to make sure we're getting this crystal clear for everyone listening because, the language of macroeconomics can be incredibly slippery. Let me try an analogy.
Let's hear it.
Let's say you own a local store that sells umbrellas. It's December, and based on the usual weather patterns, you forecast that you are going to sell $100 worth of umbrellas this year.
Okay, makes sense.
But then, a massive, unexpected storm rolls in. Furthermore, that storm completely floods out your main rival's umbrella store across town.
So they're out of business for the week.
Right. Because of this external chaos, suddenly everyone is coming to you. You revise your forecast. You now expect to sell $142 worth of umbrellas.
Right, but you didn't get a storm payout.
Exactly.
The storm didn't write you a check for $42. You were just forecasting increased sales based on a chaotic external event that shifted consumer behavior.
So, bringing it back to the RDQ report, they are now projecting that the total expected export revenue for the 2026 to 2027 financial year is going to smash previous estimates and hit, what, $416 billion?
Yep, $416 billion. And this highlights why that causal implication in journalism is so frustrating. A headline like, while amount of Countess will gain from Iran war implies a direct, almost transactional cause and effect.
It completely glosses over the fact that this $416 billion isn't government money sitting in a federal bank account.
Not at all.
It's the total projected value of goods sold by private and public energy companies. The government just collects a slice of that pie through corporate taxes and mining royalties.
What's fascinating here is the distinction between a profit and a windfall.
Oh, that's a good point. Walk us through that.
A profit implies a business-like gain. It's something a government or entity actively strategized and generated. But a windfall, especially in government finance, is a temporary surplus caused entirely by external factors.
So it's completely outside of your policy control.
Exactly. And crucially, it can vanish just as quickly as it appeared.
Okay, so if this $42 billion is just an upward revision of an export forecast, we need to look at the external factor causing the forecast to jump so drastically. Like, why are we suddenly expecting to sell so many more umbrellas? To stick with the metaphor.
Right. For that, we have to pull the lens back from domestic Australian politics and look at global geopolitics, specifically a narrow, highly contested stretch of water between the Persian Gulf and the Gulf of Oman.
The Strait of Hormuz.
The Strait of Hormuz.
The ultimate shipping bottleneck.
It really is. The entire REQ report's core assumption, the very foundation of this revised export forecast, is built on the premise that shipping through the Strait of Hormuz will not normalize until July 2026.
Wow.
The conflict in the Middle East has created a massive, sustained disruption in the global energy supply chain.
And when supply chains get choked off, things get scarce.
Yeah.
And when things get scarce, buyers panic.
Yeah.
But we need to connect the dots on the mechanics here. Why does a bottleneck in the Middle East specifically boost Australian coal and gas exports?
It comes down to how fungible global energy markets are. Energy commodities don't have passports.
Gas is gas.
Exactly. If a country like Japan or South Korea usually relies on liquefied natural gas shipments coming out of the Middle East, and those shipments are suddenly delayed, choked off, or deemed too risky to transport.
They still need to keep their power grids running.
Right. They panic, they turn around and look for anyone else in the world selling LNG.
They look at Australia.
Yes.
And because everyone is suddenly knocking on Australia's door, a massive bidding war starts.
That bottleneck is keeping global energy prices artificially elevated. Because Australia is a major global exporter of energy commodities, specifically LNG and thermal coal, these global price spikes artificially inflate the total value of Australia's exports.
So the underlying volume of gas and coal Australia is digging up and shipping out hasn't necessarily seen a massive structural increase.
Not necessarily, no. It's just the global price tag attached to those commodities that has temporarily spiked.
So the Australian economy is essentially riding the wave of external instability. The world is desperate for energy, so they are willing to pay a heavy premium.
But remember what we said about windfalls vanishing? Market volatility is the silent partner here.
Oh, right.
The report makes it explicitly clear. If the conflict in the Middle East resolves faster than expected, or if other major exporting countries like Qatar or the United States significantly increase their own supply to the global market, those global energy prices will drop.
And if those prices drop, this $42 billion projection just evaporates.
Instantly downgraded.
Wait, hold on. I'm looking at this from a purely domestic standpoint.
Okay.
If our exporters are raking in billions of dollars in extra revenue, and the government is taxing them and collecting a massive windfall, shouldn't we be celebrating?
You would think so.
Yeah, I mean, more money in the country's coffers sounds like a definitive win. Why are all the economists in the source material panicking and urging the government to lock this money away?
If we connect this to the bigger picture, we hit the most critical and honestly painful part of this entire deep dive.
The double-edged sword?
The exact same global forces that are driving this massive export windfall for the government are simultaneously acting as a wrecking ball to the average person's cost of living.
So what does this all mean for the listener? How does a shipping bottleneck in the Strait of Hormuz directly assault someone's wallet in Sydney or Melbourne?
It comes down to how energy inflation behaves. That global supply-side shock raises the baseline price of oil and gas everywhere. And energy is not an isolated, siloed sector of the economy.
No, of course not.
Energy costs impact absolutely everything you interact with. It costs a manufacturer more to run their factory. It costs logistics companies more to put diesel in the trucks that transport groceries to your local supermarket.
Right? It costs retail stores more to keep the lights and refrigeration on.
Every single business along the supply chain passes those increased energy costs on to the consumer.
So the price of everything goes up, which translates directly into higher headline inflation for everyday Australians. It's like finding out your extended family business just won the lottery, but the very next day, your personal rent, grocery bills, and mortgage double because of it.
That is a perfect way to put it, and that brings the Reserve Bank of Australia into the arena.
The RBA.
Because the RBA is legally locked into that mandate to keep inflation within a 2 to 3% target range, they have no choice but to bring the hammer down when global energy spikes push inflation outside that window.
And right now, inflation is running far too hot. We have the data right here. To cool down the economy, the RBA lifted interest rates 3 times early this year in February, March, and May.
Right.
They pushed the official cash rate up 75 basis points, taking it from 3.60% to 4.35%.
Which means anyone listening to this with a variable rate mortgage just saw their monthly repayments become significantly more painful.
Oh, absolutely.
Small businesses trying to secure loans or lines of credit just hit a brick wall.
Right.
The RBA is intentionally, systematically squeezing the consumer to destroy demand.
And they feel they have to, because they are terrified of inflation becoming entrenched. I see a lot of discussion in our sources about de-anchoring.
De-anchoring is the psychological tipping point in an economy, and it is the RBA's absolute worst nightmare.
Why is it so dangerous?
If energy prices stay high for too long, the psychology of businesses and workers shifts. They stop seeing high prices as a temporary shock and start expecting aggressive inflation to just be the new permanent reality.
Oh, so a business owner sits down to plan for next year, assumes their supply costs are going up, and proactively raises their prices today. And a worker looks at their grocery bill, assumes it will be 20% higher next year, and demands a massive pay raise today to cover it.
Exactly. Once they bake those expectations into their future plans, the inflation becomes self-fulfilling. It sustains itself even if the original global energy shock fades.
That's terrifying.
So the RBA raises rates to 4.35% to make borrowing so agonizingly expensive that demand collapses. People stop spending, businesses can't raise prices because no one is buying, and it forcefully crushes those expectations back down.
But here's the catch. The conflict in the Middle East hasn't stopped.
No.
The bottleneck in the Strait of Hormuz is still very real. The inflation isn't magically disappearing just because domestic mortgages in Australia are more expensive.
Which is why the financial predictions we're looking at are grim. Financial institutions like AMP are predicting that inflation will remain sticky.
Sticky inflation.
Yeah, because the geopolitical situation hasn't normalized, that pass-through effect of high energy costs is going to keep persistently rippling through the Australian economy.
Actually, AMP is predicting that regardless of what the government does with its tax revenues, the RBA is going to be forced into another 25 basis point hike this August.
Pushing the cash rate to 4.60%.
We are looking at a brutal contrasting reality here. On one hand, for the federal government, the war brings this massive, unexpected revenue windfall via taxes on highly priced exports.
Right.
On the other hand, for the RBA and for the average citizen, the war is a massive inflationary headwind that requires aggressively restrictive monetary policy.
It's a complete contradiction.
So we have the RBA raising rates and squeezing everyday people to fight inflation. The obvious question any voter is going to ask is, what is the government doing with its $42 billion windfall?
Naturally.
If the government has this extra cash, can't they just step in and fix the cost of living crisis? Which brings up the near $1 trillion issue hanging over the country's finances.
The national debt. The elephant in the room.
The massive elephant in the room.
The Australian Office of Financial Management states that the gross national debt sits at $974.9 billion.
Wow.
That is the total face value of government bonds currently on issue.
Nearly $1 trillion. I know a lot of people might look at that $42 billion windfall and think, great, put it towards the national credit card bill. Just pay down the debt.
It is deeply tempting to view national macro finance through the lens of household finance, but the mechanics are completely different.
Because you can't just pay it off.
Exactly. A $42 billion surplus doesn't let you automatically pay off the debt because government bonds have set maturity dates. Investors hold those bonds. You can't just forcefully hand the cash back early and close the account like paying off a Visa card.
So if they can't just instantly wire the money to wipe out debt, what are the government's actual mechanical choices when a windfall like this lands in their lap?
They generally operate with three levers. First, they can reduce future borrowing.
Okay, so if the Treasury originally planned to issue, say, $100 billion in new bonds this year to fund the government, but they have this extra $42 billion in cash, they only need to borrow $58 billion.
Right. It slows the acceleration of the debt. Second, they can maintain cash buffers. This improves the metric known as net debt, which is the gross debt minus financial assets like the future fund.
Okay, so if they aren't aggressively paying down the immediate debt, and maintaining cash buffers isn't exactly a flashy headline, I'm guessing politicians are incredibly tempted to pull the third lever.
Which is just spend it.
Just spend it.
Funding new spending is always the option with the most political gravity. But this is where economic theory crashes headfirst into the reality of the bond market. The cost of carrying that debt is a massive compounding problem.
Because as the RBA raises interest rates to fight inflation, the yield on new government bonds goes up too. The interest payments required by the government just to service that $974.9 billion debt burden get heavier and heavier.
So we have a fierce tug of war.
Right.
On one side, if the government saves the windfall and reduces borrowing, they reduce their future interest payments and lower the overall trajectory of the national debt. It's the responsible, long-term approach to fiscal repair.
But politically?
Politically, if they lock that money away, they're doing it while everyday citizens are drowning under the weight of high interest rates and expensive groceries.
And the other side of the tug of war is immediate gratification. The government could take that $42 billion and pump it into immediate cost of living relief.
They could fund infrastructure projects, inject cash into the National Disability Insurance Scheme, or hand out broad tax cuts to help people survive the high interest rates. But this raises an important question, perhaps the defining macroeconomic dilemma of the moment.
Which is?
If the government spends the windfall to help people afford the higher cost of living, they put more cash into people's pockets. Those people go out and spend that cash.
Which fuels the exact same demand-driven inflation that the RBA is desperately trying to crush.
Yes. The government spending and the RBA rate hikes end up working completely against each other.
It feels less like driving a car with one foot on the gas and one on the brake, and more like, I don't know, trying to bail water out of a sinking boat while someone else is actively drilling new holes in the bottom.
That's a grim image, but very accurate. The government is trapped between the mathematical necessity of fiscal repair and intense, immediate political pressure from voters who are suffering.
Because if the government spends the windfall to ease the pain now,
AMP's prediction of a 4.60% cash rate becomes almost a certainty. The RBA will be forced to hike rates higher to offset the inflationary impact of the government spending.
so politicians are essentially forced to choose between helping voters today with financial relief or bankrupting them tomorrow, because those very relief measures force the RBA to push mortgage rates into the stratosphere.
It is an impossible balancing act. If the government banks the money to suppress inflation and satisfy the RBA, they have to face the wrath of voters who feel entirely abandoned by their leaders during a historic cost of living crisis.
It is a phenomenal, incredibly complex web, and, it really brings this entire journey full circle.
It really does.
We started with what looked like a simple, highly sensationalized headline about a $42 billion war profit. But by actually digging into the REQ reports and RBA data, we realized it was simply an export forecast revision tied to a severe shipping bottleneck in the Strait of Hormuz.
We uncovered the actual mechanics of it.
Yeah, how that same global energy spike causing the government's windfall also forces the RBA to push interest rates well over 4% to fight domestic inflation.
And finally, we explored the government's agonizing choice between managing a $974.9 billion gross debt and fueling the inflation fire by handing out cost of living relief. It highlights just how deeply interconnected and fragile the global economy is. And, well, it leaves you with something to seriously mull over long after you finish listening to
Oh,
this.
yeah. What's that?
If external global shocks, like a shipping bottleneck in a strait half a world away, have a greater immediate impact on a nation's inflation, its interest rates, and its household budgets than domestic policy does, how much control does any single country truly have over its own economic destiny?